Thank you so much for joining us today.
Hey, Elijah, it's always nice to visit with you. I hope you are doing well and that everybody at Silver Doctors is doing well.
Definitely. And this is an interesting day in the markets today. We see precious metals going down, gold dipping below 1,300. Now, you actually predicted a dip in the metals. Is that right?
Yeah, it was pretty easy to see these things coming sometimes. And frankly, that's the reason why there's a TF Metals report in the first place. When I first got my start at this 8 years ago, for crying out loud, it was unintentional. We didn't intend to go on this road, obviously, but it seemed that there wasn't anybody out there that was, I guess, evaluating or analyzing the precious metals markets from the point of view that they are fully and wholly 100% manipulated by the banks. Everybody wanted to look at the markets, in some kind of traditional sense, Elliott wave, and supply demand and all this other stuff that doesn't really amount to a hill of beans. With the way we look at the market, we call it manipulation analysis. And we understand that the precious metals markets, if you want to call it that, are actually just digital derivative markets. There's no real gold or silver that ever changes hands. They just trade these derivatives back and forth. And so if you understand that the banks issue the contracts, they sell them to the specs. The specs build up big long positions. The banks build up big short positions. And eventually momentum fades out and those specs get washed out. They start dumping their long positions. The banks use all of that spec selling to buy back their short positions. And eventually, those positions get all washed out, as we call it, and then the whole cycle begins again. So knowing that, it gives us, I guess, a different perspective, a unique perspective in analyzing and predicting where price is headed. And a couple of weeks ago, we started stating and writing for our friends at Sprott Money some analysis and said, hey, look, this is happening again. Here it comes again. And lo and behold, as you and I speak here on May the 15th, it's happening before our eyes. Price has been broken down today below the 200-day moving average for gold. This happened 3 times in 2017. On each of those 3 occasions, price fell on average $35 or so below the 200-day moving average before it turned. If that were to repeat itself now, we'd fall down to around 1270 or 1275. In washing out the specs, when that happened, the cumulative position of the large speculators in COMEX gold was dropped anywhere from 40,000 contracts to 100,000 contracts. Again, speculators selling because of the technical positioning below the 200-day, and the banks using that spec selling to buy back their shorts. That process then concluded, like I said, with a drop of $35 or $40, and then the next rally began. So like I said, we tried to begin warning people about this 2 weeks ago when you could see this coming, and now it's playing out before our eyes. And the important thing is to recognize what it is and prepare yourself for that next buying, stacking, trading opportunity, which will probably emerge in the next, week or so.
When you're talking about, how the banks are involved and everything like that, is there any speculation here, or are there hard facts to back this all up?
Yeah, when we reference the speculators and the banks, we're basically a shorthand for the information that's generated on a weekly basis by the CFTC, the Commodity Futures Trading Commission. They survey all the market participants every Tuesday. They put out every Friday a summary of that survey called the Commitment of Traders Report. A lot of analysts follow this. I've been following it my entire time that I've been running TF Metals Report, and we report on it every week. To the extent that it's factual and accurate, and I guess we can debate that, whether the banks have been caught in the past lying and misleading the CFTC and falsely stating their positions, but all we can do is take the data that were given to us. And so if you look at the actual data, then you can see this ebb and flow of positions from the specs to the banks, from the banks to the specs, and use it and track it with price. And the picture becomes very clear. In fact, I'll be more than happy to send you one of the charts that I have that just shows you what happened last year. As price fell through the 200-day moving average, the speculators, almost because they were pre-programmed to do so by computer, began dumping positions. that selling of their longs was used by the banks to buy back their shorts, and you can see how those speculator and bank positions change with price.
Definitely. If you send me those links, then I'll put them into the description of this video so people can check those out. As for going forward here in the precious metal markets, do you see that gold and silver are cheap right now and that they're going to rise in the near future?
Yes, I do believe, Elijah, that the bear markets ended back in December of 2015. In fact, guys, you go back to December 2015, everybody hated gold and silver. I mean, everybody, I don't think there was a single analyst that thought that price was going to turn. Outside of yours truly. I mean, you can go back and search my site. In fact, I reposted a link for my subscribers this morning from December of 2015 where we said, you know what? No, we're not going down. We're going to rally in January and into February. And then from there, maybe we'll continue to rally. And that's in fact what happened. So at the peak of bearishness, at the peak of those positions, speculator and bank being washed out in December of 2015, at the end of the bear market, that was the time that you had to have the fortitude to see what was going on and go long. And if you did, you're rewarded with a 30% move in gold, a 50% move in silver, and 3 and 4 and 500% moves in certain miners. I think that's where we are again. I think this process that you're seeing play out today is part of this washout of the market structure, and prices are beginning to rally and will rally substantially in the back half of this year and into 2019. I compare 2018 to 2010 in that back in 2010, when I first began my website, everybody was convinced there was not going to be any more QE. There'd been a QE1 program that was started in March of 2009. It ran its course for about 6 months, and that was it. And the Fed said they'd never monetize the debt, and Bernanke was done with it. It was just a one-time deal. Well, by the fall of 2010, we got QE2. Before that happened, during the bulk of 2010, silver traded around $16 to $18 most of the year. But once QE2 began, the wheels kind of came off. And of course, we know what happened with silver. It about tripled between then and May 1st of 2011. I'm not saying it's going to triple again in 6 months, but I do think this year looks a lot like 2010 in that right now everybody thinks, oh, yeah, the Fed's going to tighten and the economy's great. I think by the end of this year, early 2019, we're going to be looking a lot like late 2010. The economy will be slowing, we'll be tipping over to recession, whether it's through higher interest rates or an inversion of the yield curve or whatever. This is going to happen. And the Fed's going to be talking about loosening policy and maybe even QE and negative interest rates and all that stuff again. So, yes, I do. I'm bullish. I think the bear market's ended 2.5 years ago, and we're about ready to start a powerful leg upward once we get this most current ongoing washout behind us. I'll give you one more thing, Elijah. I think it's very important. It was about 2 weeks ago, Goldman Sachs, who I think most of us despise. However, in the traditional money management community and, for institutions worldwide, they're widely respected. And Goldman Sachs put out a note that said, advising their customers to begin building positions in commodities, because commodities so far this year had outperformed equities, and they expected that to continue. If Goldman Sachs starts, driving institutional money into the commodity sector, man, there's just not a lot of places for that money to go. I mean, there's only, so many copper contracts and copper ETFs and, crude oil and grains and all that kind of stuff. There's only so many mining shares that can be bought. And so you can really get a rush in a virtuous cycle of higher highs with increasing money flows if that whole sector starts to take off. And I think that's what's going to happen too. So anyway, that's a very long answer to a short question, Elijah. But I think this current situation we're dealing with today and probably into maybe the next week or two, once that is behind us, it sets up I think another very powerful opportunity for those willing to take the bull and run with it.
Right now, what is your perspective on the geopolitical tensions currently in the Middle East? We have a lot of things going on. We just had a conflict between the Israeli military and the Palestinians, where a lot of people were killed and injured. And we also had the U.S. Embassy finally opening in Jerusalem, and that basically meaning that the U.S. is recognizing Jerusalem as Israel's capital. And then we also had, a week or so ago, Trump pulling out of the Iran deal. With all these tensions in the Middle East and, geopolitically, how do you see that impacting precious metals?
Well, I worry about it first and foremost for the loss of life. It's just terrible to see the images that you see on the news of what's going on over there, and whether it's in Israel and Gaza or what's taking place in Syria or, even all around the Middle East. It's a human tragedy first and foremost. But I think as it relates to gold and silver, it plays into one of our ongoing themes that we discussed at TF Metals Report. In fact, we wrote about it in January for what we call the 3 themes of 2018, and they all have to do with the precious metals and the dollar. You've got political risk here in the U.S., which I think we're not really seeing yet, but as we get closer to the midterm elections, is going to kind of be moved to the front boiler. You've got this geopolitical risk, as you're talking about, and I think that ties into de-dollarization risk. And that's where to answer your question, that's where this is headed. For the U.S. to, again, now want to impose sanctions on Iran, that drives Iran closer into the arms of the Chinese and the Russians. Iran already only trades and prices their crude oil in euro, not dollars. And this will continue to drive a trade that prices energy, prices crude oil in things other than dollars. You've now got a contract that trades in Shanghai where crude oil is denominated in yuan. All of this infrastructure and all of this increasing trade is set up as a counter system to dollar hegemony. And that's all that we've ever known, really. Anybody that's alive today only knows the U.S. dollar is the world's reserve currency. I'm not saying that the world's U.S. dollar is going to lose that status overnight. But what I'm saying is this system is being set up to rival it or to offer an alternative outside of the dollar system. And so when the U.S. takes these military moves, it's really isolating itself to a great extent from these other parties, Russia, China, the primary ones. And they are the ones that are setting up the foundation. They are the ones that are offering the alternative. And so this geopolitical worries that we have are actually serving to speed up the process of this de-dollarization risk. Again, it's not going to happen overnight. Nobody was expecting, when that yuan-denominated crude oil contract started trading last month, nobody said, this means this is going to reset the system on Monday. No, it's a piece of the foundation of this alternative system. All of this military stuff and the geopolitical stuff and the U.S. involvement around the world, where we kind of arrogantly try to dictate the terms to everyone, just simply speeds up the initiation of that new benchmark, that new alternative to the dollar. And that's where it's headed. So ultimately then, if you have less demand for dollars and a growing supply of dollars, that's going to, by any traditional economic sense, decrease the value of the dollar. And if you decrease the value of the dollar, that's going to make things like gold and silver more valuable, commodities more valuable, all that stuff. And you can begin to see how these pieces fit together. So first and foremost, it's a terrible loss of life. And you just hate to see people that, just living in a constant state of fear and war instead of peace. But in a big picture, it is driving the world away from the U.S. and away from the current system. And that has significant long-term implications.
Definitely. Now, speaking of the petrodollar, what is your perspective on, there have been predictions that the U.S. will become the world's largest oil exporter anywhere. People are predicting from next year to 2023. How would this impact the petrodollar?
Well, obviously, we're going to sell our own crude as an exporter for dollars, right? And so that's going to help to somewhat mitigate the move away from everybody else pricing their crude oil in dollars. but I don't think it's enough to change where this is all headed. Again, when we talk about the petrodollar, people need to Google that term and understand what that is. You know, when we went off the gold standard in 1971, there was an understanding by the powers within the U.S. government that this was going to be extraordinarily inflationary. We were going to be printing dollars, you know, in the Keynesian sense, trying to have both guns and butter. And we were going to be untethered to any kind of sound money. So that meant there was going to be this rapidly increasing supply of dollars, which is, I mean, anybody can pull up the charts and see how the standard of living in the U.S. has dropped dramatically since 1971. So if we're going to be increasing the supply of dollars quickly, we better figure out a way to hold steady or grow the demand for dollars. And thus, the petrodollar, I guess we'll call it recycling scheme, was born, where Henry Kissinger went to Saudi Arabia and convinced them in 1973 to always price their energy in dollars, which meant there was always going to be demand for dollars. So as we print dollars here, we're able to ship them overseas. Exporters of oil would exchange their oil for dollars. Now, with their dollars in return, what are they going to do for them? They're going to buy our treasuries, our debt, and quarantine those dollars so that they're not inflationary, and the whole thing just kind of gets recycled over and over and over and over on a larger scale. And that's what's happened for the last 45 years. If we move away, if eventually as the world moves away from solely pricing crude oil in dollars, instead starts to price it in yuan, instead of charge it in euro and whatever, again, that decreases demand for dollars. And if anyone's taken Econ 101, you move that equilibrium point where supply and demand intersect, and it changes price, it changes value. And if demand falls while supply increases, that lowers the price, that lowers the value, and that's ultimately what this is all about. So, the U.S. becoming a net exporter, increasing the supply, the global supply of energy, okay, that's all going to be sold. The U.S.'s supply is going to be sold in dollars, fine. But if Saudi Arabia, all of OPEC, everybody else begins to move away or begins to at least not only sell their oil in dollars, that's going to dramatically decrease the demand for dollars. That's going to decrease the demand for U.S. debt. It's a whole mess that's coming. But again, not overnight. This is a process that's been unfolding now for at least the last 10 years. And the world's going to continue to offer this process as an alternative to the dollar. And I just have no doubt that that's the direction this is all headed.
Right, and I've heard the opinion of some people that, all fiat currencies are, backed by nothing, and eventually they're going to collapse. But in this day and age, it's really the dollar it's the one that is the most stable right now. With the destruction of the petrodollar, will this change that situation where maybe the yuan or a different currency will become top dog?
Or I guess make them all on a more equal footing. Yeah, to where you don't have to transact trade in dollars only, because there are facilities to transact trade directly between countries. Like China has set up, I don't even know how many direct currency swap arrangements now with other countries where, having the world's reserve currency status, where that always has demand for your currency, is because if you're, pick two countries, Egypt and South Africa, and you want to transact trade, between those two countries, they don't do it in each other's currency. They do it in dollars instead to make the whole transaction more stable. And so thus there's always this demand. Well, you're getting to the point where countries are comfortable doing things and bypassing the dollar and working directly. That's what those direct currency swaps are that China has set up with Russia and Iran and India and all these other countries, so that they can transact trade and bypass the dollar, bypass the SWIFT system, and not allow the U.S. to hold them hostage, by potentially excluding them from the dollar system, by excluding them from the SWIFT system. And so these systems are being set up as an alternative. So would it replace the dollar? Probably not, but it would just be offered there just would be alternatives to the dollar, and the dollar would not be, on the top platform with a whole bunch of others at like a tier 2 and then a whole bunch of others down at tier 3. There would just be the dollar and everybody else would now be on tier 2, if that makes sense. And that's kind of what I see coming. And in the end, that's very inflationary for the U.S. It's really going to create a problem if demand for dollars dries up and thus demand for U.S. debt dries up, because that implies a lower dollar, that implies much higher interest rates, and we're not prepared for that economically.
All right. Well, Craig Hemke, thank you so much for joining us today. Before we let you go, did you want to share with the viewers any last thoughts you had and where our viewers can find you online?
Well, I mentioned this site that we've been publishing now for about 8 years. It's tfmetalsreport.com. It's a vibrant online community. It's terrific. The people there, the subscribers that we have as they interact, we realize we're all in the same boat and we're all there to help each other. And for $12 a month, you get my analysis of every day, where we write about the markets and we do a podcast every day and have interviews with other analysts and other people in the industry. But you also just get access to the entire community. And I think that's what makes it most valuable, is people that are all working together to help each other, each other see each other through this process. And I encourage everybody to check it out. Again, just tfmetalsreport.com is where you find us. We ain't going nowhere, man. And we've been at this for 8 years, and we ain't giving up just because the commitment of traders report is getting flushed out again today. We can see where this is headed. We're confident that we're analyzing